are recorded. Access the videos again on our YouTube channel at the Rec Innovation Lab on YouTube. And all the videos recordings are typically available within about 24 to 48 hours after the workshops. So that said, welcome to everyone. We are going to get started here in just a moment. I just want to remind everybody that if you could keep your cameras and your microphones turned off unless you have a question. And then remember to turn those microphones on so that we can hear you. You can also put them in the chat. We'll monitor the chat as we go. And if there's anything pressing, I'll let you know, Jack. So
okay.
Yeah, welcome. Thanks so much for being here today. We appreciate you coming.
Thank you. Thank you. It's a privilege to be here. You know, I'm often on the campus because I live nearby. And you guys are really privileged to have such a nice, beautiful campus. You know, I remember growing up on Long Island, and our community college was way off in the hinterlands, and you know, it wasn't terribly nice and appealing. And it was like high school extended as far as perception. And you know, the perception of community college has changed, and it needs to change.
Agreed.
Because you know what you get at a community college in terms of the level of involvement from your professors and your teaching staff is far and above anything you get at a four-year college. You know, there's some great teachers at four-year colleges. Don't get me wrong.
Right. No, I've been at four-year college for a long time, and I teach at both. And I agree. I agree. I think that the teachers here at community college, they really are just so involved and so dedicated. And a lot of it, I think, has to do with the class sizes and the students. We get some pretty amazing students at the community college. Not to say anything wrong about university, but
it's terrific. And you know, the professors generally don't have as much pressure in terms of publishing as at a four-year or a research institution, and so they can really dedicate themselves to teaching. And as Tanya said, the class sizes are often smaller. You get more attention from the staff, and at the end of the day, the cost of attending a community college is so much more economical than going to a four-year school. So, and at the end of the day, if you go to a four-year school and transfer, you know, your degree is going to say whatever your degree says upon it. You have a four-year degree, and the credits that you earn and the education you get is very valuable for the first 2 years. So, you know, I credit and commend everybody who gives community college a good consideration.
Well, I love that. Thank you for saying that. And just before I pass it over to you to dive in, I do want to say a couple of things about the work that we've done together and that we've done with you. So Jack has been an advisor here at Miramar for many years, an advisor to our business and our entrepreneurship programs. He's also he has the unique perspective of being both an investor and an entrepreneur. And so it's great when you can get people who have that real world unique experience that they can share with you. And I know a lot of the people, I can see a lot of the people in the room here, they're early stage startup founders who, you know, now is the time to start thinking about raising funds and vetting the people that you're raising the funds from. So Jack is the perfect person to talk to you about that. And with that, I'm going to pass it on to you and let you take it away.
Okay, I'm going to do a little screen share right here, if I may. Okay.
Absolutely.
Let's see if I can get this going here. Okay. Let's see if this works. And let's get this going. Can you see that?
We can.
See that?
We can.
Okay. All right. So for the purposes of this presentation, we can either make this conversational or we can hold questions to the end. I think conversational is fine. If you have a question, if you can put it in the chat box, if either, if someone can monitor the chat box and just call out a question, that would be great.
Crystal and I, we'll stay on top of the chat and we'll let you know when things come in.
Well, great. Okay, so today's topic is raising capital and being vetted by investors and vetting the investors as well, because investment is a two-way street. You know, the investors are going to take a look at you and put you under a microscope. And at the same time, you know, as the project manager, as the project owner, as the business owner, it's incumbent upon you to make sure that you're working with investors that really understand what you're all about. So it's like a marriage, and it should be vetted like a marriage, and it should be treated like a marriage. And with that, let's talk about the big question. And the big question that investors will always have is, why should they write you a big check? Why is someone going to give you $25,000 or $10,000, $1 million, or whatever it is? That's the big question. It's, why are you investable? What makes what you do so different, or so unique, or so valuable, or so earth-shattering that I'm going to write a check, and at the end of the day, I'll get some returns out of this? Because at the end of the day, investors are selfish, to be quite honest, and they like to see a return on the investment that they make, as well as the success of the folks they invest in. So you have to be able to answer this question, and it's generally an elevator speech. So if you can settle out or nestle out in 20 words or less why they should write you a check, it'll hold you in good stead when you talk with investors. So let's talk a little bit about some of the questions that investors might ask. And the question that they have is, do you have a business plan or a revenue plan for your business? Having a roadmap for what you're trying to accomplish just puts the investor at ease, because they want to see what your thinking is. They want to see what you've thought about, what contingencies you've thought about. They want to see what markets you're addressing and the like. They want to see what your timelines are. They want to see what your revenue plans are. They want to see what your valuations might be. They want to see if what you have is viable, whether it's in the ballpark or not. And if you follow the startup community, you'll know that some projects come out. They're looking for, let's say, $500,000 or $100,000, and they come up with these huge valuations. And when we present our clients to the investment community, the one question that most investors have that's left unanswered is evaluation, because most startup folks get the evaluation, they're off a little bit in terms of real world expectation. So it's really important that your business plan is pretty tight, and your revenue plan and your valuation plan is within real world estimations. It'll turn an investor off if it isn't. So those are things to think about. And then in your revenue plan, I don't know if you can see this or not, I'm going to minimize this for a moment here, is a pro forma revenue spreadsheet that'll lay out what your revenues are, what your expenses are, when your net profit turns from negative to positive. And as fast as you can go from net negative or zero to positive revenue, that's what investors are looking for, is the time frame. And as you know, some projects take a little bit longer time to go from startup to revenue and then profitability. I see a tremendous number of biomed, biotech opportunities out there. And I don't know if folks in the classes here are pursuing opportunities in those veins, but those are long-term projects and startups. They're typically 8, 9, 10 years in many cases. And the trick, for those guys is to figure a way to monetize some of the work they're doing before they get to the project, because most of those projects never make it to finalization. They never make it to the market. What happens in a lot of cases, though, processes or other IP along the way that's developed gets to market well before any product would ever get to market. So those are things to think about as you create a business plan and a revenue plan. Okay, let's be real for a moment. When you look at the revenue plans of a startup company, the sky seems to be the limit. But in the real world, for whatever you're developing, whatever product or service that you're developing, there's what's called a total available market. That's the complete universe of anybody and everybody who could ever possibly want to take advantage of your product or service. And let's talk about a $10 million market. Let's say shoe market as an example. So there's a shoe market worth $10 million. Well, within that market, there's what we call a serviceable market. There's a portion of the market that you hope to address through your unique product or service, your unique shoes, let's say. Okay. So if it's a $10 million total available market and your product or service can address, let's say, a third of that. So you've got a $3 million market potential there. Okay. And so after you realize what your serviceable market might be, there's the ideal market, which is your targeted customer. What's the profile of your ideal customer, which is a subset of the serviceable market. So that subset might only be 2 million, let's say. Okay. So now you're looking at 20% of the total available market as the revenue potential for your product or service. And then how much can you really capture? And that's going to be a function of your marketing success and how much money you're able to put into marketing to reach the ideal target, the ideal customer in the ideal market to sell and service your product. So when you come up with your pro formas, you have to take these things into consideration and try to make sure that the numbers on your spreadsheets are real and achievable, because an investor will look at that, and investors who invest in certain industries pretty much know the market sizes that companies are looking at, and they can tell with fair amount of accuracy whether or not these numbers are real or not. So try to be real. It's better to underestimate and overperform when you do pro formas. You don't want to be too far off. It's like Wall Street. When you come up with a projected earnings sheet and you're off, they don't mind if you're off by a very tiny amount one way or the other, but when you're off by a big amount, they kind of get the idea that you don't really know what you're talking about. So it's okay to make marginal errors, high or low, but try to be as real as you can in terms of identifying the marketplace. It'll help the investor provide credibility for your project. So let's talk about for a minute your team, because this is one of the things that investors really look at. They want to know who is running the show, who is going to be the steward of the funds that an investor is going to be investing in. And this is key. You want to make sure that you've got superstars on your team. You don't have to be a superstar yourself. What you have to do as the entrepreneur is you have to be able to identify areas that you're strong in, areas that you're weak in, and patch up those areas and surround yourself with folks who can make up for your shortfall in skill set. And if you can identify people and involve people in your project that enhance your innate ability and make your whole project better, it provides the investor with a lot of confidence in looking at your project. So, make sure that if you're going to have a project and you're going to involve other people, make sure these people are going to be additive to your project. You want to make sure that for whatever weakness you have, you've got somebody there who can stand tall and beef up your operation and contribute in a very positive way. Let's talk about for a minute identifying the industry. It's really key when you create a business plan and you're looking for money to identify what industry and what sub-niches of industries you're trying to target. And you could be a financial tech service or a SaaS, software as a service play, or you could be manufacturing an item. But you really need to identify the industry, because the industry will help the investor figure out exactly what their risk is when they're looking at industries. And it's just important that you focus on a specific subset in an industry. The next thing to look at is make sure that in your value proposition, you're identifying what need or what problems you're solving or addressing. It's really key to be able to succinctly message that to investors. They want to know what are you fixing? What's broken? The old story about buggy whips back in the turn of the century, and this is classic. Somebody comes out with an improved buggy whip, the best buggy whip that was ever made at the time when automobiles are starting to replace covered wagons and horses and the like. So make sure that you've got a problem or a solution to a problem that needs a solution. Right. And then finally, this is really key. And I try to talk about unique value propositions, unique selling propositions using this diagram. So there's a universe of folks out there that want something. There's a need, there's a want, there's a problem. And there are competitors out there who may do what you do or try to do what you do. And then there's what you do. There's what they do well that you don't do. There's what you do well that they don't do. And the tripping point, the nexus point, is when what you do is different enough from your competitors and it's what the customers want. It sets you apart. So you want to get your project, your product or service to fall in that red area on the customer need problem solving scheme. And it helps you focus on identifying what's unique about your company and what problem you're solving. The biggest mistake that you could possibly ever make in business is creating something that is the best thing since sliced bread when nobody's eating bread. And so, make sure there's a need and a problem to be solved, and what you do is unique and sets you apart from the competition. Let's look at the next thing that investors are curious about. They want to know where you are in the life cycle of your company. So this is a little diagram that I use to talk about investor types. And this will show up again later toward the end of the presentation. So you could be in the first round in your pre-seed round, looking for anywhere from $10,000 to $1 million. And by the way, when you look at these numbers at the bottom of the screen, please understand that these are just road cones. They're movable. There's no set numbers here. This is not gospel from God here. This is basically just road cones, and they move. So each investor entity that's out there will have a different perspective on these numbers, but these are just kind of generalizations. So please keep that in mind. So pre-seed is anywhere between $10,000 and $1 million. When a company is up and running and starts to begin creating and selling what they're selling and what they're making, and they're actually in revenue or revenue growth, they can go out to the market for what's called Series A money for development and additional branding and marketing. When you get to a point where you want to expand in the marketplace, you go to what's called Series B. This is a growth stage. And finally, if a company matures enough and gets to be big enough and is in business long enough, they may want to think about expanding the point of either acquiring businesses, going after new markets, creating new products, or going public. And so these are the different various stages of development in the life cycle. And these are the kind of the revenue, the funding levels that you might find at various stages. And again, please, these are not gospel. These are just kind of road cones. And so you can use that as a guideline. The other question that they want to ask is, how much money have you raised? And this becomes an important question to be able to answer. If you're right out of the gate and you haven't raised any money, you're at the pre-seed or pre-launch stage, and that's fine. It's not necessary to have investors. But if your project is up and running a little bit, investors want to see that the other people are involved in the project. And the biggest challenge that startup folks have is, who's first in? There are a lot of investors out there. There are angel investors and there are high net worth individuals out there that are more than willing to write pretty substantial checks to innovative startup projects, but they're gun shy. They don't want to be the first investor in the project. So it's really key that, if you've raised some money in the past, whether it's your own money or whether it's money from friends and family, or whether it's money from an investor, it's key to be able to talk about that so that investors have a confidence level in your project. And there's nothing wrong with bootstrapping, starting a business from your own money and having that project succeed. Because if you're putting your money in, you've got your own skin in the game and your project is moving forward, that's just as investable a project from an investor's point of view as having a bona fide third-party investor, because your project is moving along and you're demonstrating success. That's the whole point of this question is, are you demonstrating success? And when an investor sees that, they're more than willing to write those checks, which is what you want. That's your goal, is to get the money. They used to ask Willie Sutton, who was a bank robber back in the 20s. They asked him, "Why do you rob banks, Willie?" And Willie's answer was, "Because that's where the money is." Right? Keep that in mind. The investors are where the money is. It's very important to keep them on your side. Okay, let's talk about the minimum viable product. When you have a project, a product or a service, it's an important stage in the development of your business is to be able to demonstrate that what you have is something that people want. And so, we use this example of a candle here. A candle is a great idea. It provides light, and it's a rudimentary, basic, bare bones, functional thing to provide light to folks. Okay, but is it unique enough to entice people who are, skeptical maybe to get involved in it? And if you develop enough of a project to the point where people get in early, you have early adopters, then you can turn those early adopters into evangelists and move on to your more finished product, a more advanced version of your product. And that's the product that you go to market with.
Hey, Jack.
So, yes, sir. Yes, ma'am.
Sorry. We have a question in the chat.
Yeah, let me just kind of.
I can read it for you if you want.
Oh, sure. Okay.
So someone wants to know, is it more of an interest in seeing who else is involved or seeing how much debt is being leveraged or possibly over leveraged?
Okay, let me digest that for a minute. Are you talking about from the entrepreneur's point of view or from the investor's point of view?
From the investor's point of view.
Okay, so when you talk about leverage in a startup is something that really doesn't exist, because startup folks don't really have access to debt capital. Most sources of financing for debt capital come from companies that are up and running in revenue already. So, leverage, the idea of leverage money in a startup is something that I don't really see. What I think you're asking is if there are too many investors in the project. Is that
maybe I'm thinking more of like angel investors who do more of like a loan type deal. If somebody's got X thousands of dollars and they only have so much revenue or growth, does it justify additional money being invested in them?
Yeah, investors do look at that. It's important that the money that has already been invested has got to be producing forward movement in the company towards profitable revenue, or the achievement of a minimum viable product or some other milestone. And investors really look at milestones. The milestones can be steps along the way to getting a product finished. It could be a revenue, it could be a profitability milestone, it could be any number of milestones, but that's a very important question. And yes, they do. They do look at that. Nobody's going to invest in a project that, one, has too many investors in it, or the project is dragging its feet for some reason or another. And I think that's the gist of your question.
Yeah. Thank you.
Okay, I hope I answered your question there. Thank you. Okay, are there any other questions in that regard? Okay, so having a minimum viable product is really key to establishing proof of concept and establishing that there's a product or service out there that people want. So, and I know in speaking with folks before the presentation that some of you are working on your MVPs. Keep working on them and get them refined. There's one thing I caution though, and this is an axiom of management in general, is that a perfect project never executed is not as good as an imperfect project executed on time. So, temper that with a little bit of advice that, sometimes you want to get your product to market. It's not quite finished. It's good enough. It's not perfect. Perfection is great. It's great to reach for the stars. If you get to the moon, that's terrific. But keep in mind that perfection is the bane of any startup company. Perfection is hard to achieve, especially when you're looking for funding. It's a tough thing to do. And the other thing that I'll mention along the way while we're on that subject is that there's time slicing that goes on with startups. There's the process of finishing your project and getting it to market, and looking for customers and the like, and developing your project. There's also looking for money. Both are extremely important activities. Both are full-time jobs in reality. And it's important that as a management team or a manager or an owner, that you really mix up your time and use your time as wisely as you can, because you don't want to spend too much time looking for money and have your project lag. And you don't want to spend too much time on your project and not look for the money you need. So it's a delicate balance, and keep that in mind and be aware of that. It's important from your own development perspective. So the other thing you look at is a revenue model. These are some examples of revenue models. These aren't the only revenue models that are out there. The world is changing rapidly. People are really creative. Even having a different revenue model might be part of your unique selling proposition. And so as you develop your business plan, as you talk with investors, as you look at your pro formas, keep your revenue model in mind, be able to articulate it, be able to talk about, that total available market, that ideal customer, that percentage of the market that you can capture, and then also talk about profitability, because you can sell dollars for 99 cents all day long in a business and go broke doing that. So, keep in mind where your money's coming from, where your revenue's coming from, whether it's renewable revenue, whether it's lifetime value of a customer revenue, whether it's freemium model, whether you're selling directly, which has a higher profit margin, or whether you're selling through channel partners, which of course will require some discounts for resellers, so your margins are a little bit lower. So keep those things in mind as you develop your revenue model. It's real important to articulate that to an investor. The other thing that's important is your burn rate. If you're starting a company and you're expending money on various things, keep track of that. This is a chart that talks about how much money you spend over the life of the stage of your product and your business. At the beginning, you're going to spend a lot of money with getting your business up and running. Particularly, you're going to spend a lot of money in marketing as a percentage of your revenue. It's going to be a bigger percentage of your revenue at the earlier stages in your company. And as your revenue grows, your percentage of marketing dollars to revenue should decrease. It gets to a point where, as a startup, you may be spending 25% of your revenue on marketing. Okay. And as your revenue grows, that percentage should get down below 5%. And if you're a company that's in, a mature stage and a high revenue stage, you want to get that under 3 or 4%, because there's a law called the law of diminishing returns in marketing. You can only spend so much money in marketing reaching your target market, and the only reason that money would go up, the marketing money would go up, is if you're taking new products to market or you're going into new markets. And so on. So keep in mind that your burn rate, how much money you're spending of your capital reserves is key, and investors want to know what your burn rate is. Okay. Most important question is, how much money are you looking for? And if you're going to ask for money, assume that you're going to run into unintended events, unforeseen circumstances. And I always taught, especially with software companies, the rule of thumb for software is when they tell me that a project is going to take a year to finish, I go to 2 years and then double it. It generally turns out that folks don't ask for enough money at the startup stage. You can ask for too much, obviously, but if you underestimate what your runway of funding is out of the gate for a startup, you're going to end up having to go back to investors to raise more money. And that's going to detract and take away from your ability to work at your company, to grow your company. So, as you think about raising money for your project, think about unintended events that would come along the way. I mean, if nobody could foresee the pandemic, I mean, that was, once in a millennial kind of a thing. And it's affected people and so on, and people's businesses have been affected. But think about asking for 15 to 20% more than you actually need for contingencies, and use that money, keep that money in reserve, so that if something comes along that's unexpected, you have the money to do it. And then they want to know exactly what you're going to use that money for. So typically it's for product development, it's for licensing, it's for legal fees, it's for hiring, it's for sales and administration, it's for acquiring office space or equipment or whatever. So be able to articulate that very succinctly. You don't have to go into massive detail, and that should be in your business plan. But have a good handle on what the 3 or 4 things that the bulk of the money is going to be used for, and be able to articulate how long that money is going to last. The runway. It's called the runway. So, keep that in mind. And I will tell you, at the end of 2020, when the pandemic was in full bore, the beginning of 2021 was an explosion of folks who left industry. There was a massive departing of folks from businesses, and people didn't leave the workforce. They either went to other companies or they started companies. We had our busiest 3 or 4 months from December of 2020 through through April of 2021, with companies, new startups. People were looking for money to start their own business. They liked the idea of not being in an office or tied to a company. They liked being their own bosses. So it was a good time. It still is a good time now. So if you're thinking about starting a business or you started a business, stay on track, because you become your own destiny at that point. Don't ever detract you from doing that. This is a whole subject in and of itself. And each of you who are out there who are developing a company or a project have advisors. And it's important to talk to those advisors and understand ways that you can raise money and what you have to give away in the form of a term sheet. And the term sheet defines the arrangement, the conditions of the money that you're going to attract from an investor. So there are 3 main ways for startups. And again, I'm focusing on startups because startups are very different from companies that are already in revenue and significant revenue. When you're a startup company, you're going to attract equity capital, and only equity capital. It's very rare that a startup company, unless it's a watershed, once in a millennial kind of a project or service, is going to attract debt capital. Debt capital only goes to folks who are in revenue who can service the debt. And there's generally a threshold of revenue. It's generally $5 million or more. Again, it's a rule. It's just a guideline. It's not an absolute. So when you're starting up, you're going to be looking for equity capital. And the equity capital can come generally in the form of 3 different ways. One is a safe note, which is, kind of a convertible security that is not debt. It stands for a simple agreement for future equity. And it just provides a rate of return, essentially, for an investor. It's the simplest way to raise money. And a lot of angel investors or high net worth individuals like to work within safe notes. It's a very favorable form of equity term sheet. The other kind of way to go is what's called a convertible note. And a convertible note includes an interest rate and a maturity rate or a discount rate. So you might see a convertible note that says, I'm going to offer you a convertible note that says, I'm going to give you a 20% rate of return on your money at this particular date. And oh, by the way, you'll be able to buy stock at a 10% discount if you want to buy stock in the company. And that's another favorable way that investors, especially angels, especially high net worth individuals, and especially family offices, and I'll talk about those types in a minute, They like to do convertible notes. And again, if these are things you're considering, talk with your advisors. Most of you, if you start a business, you're going to need an accounting advisor. You're going to need a legal advisor, and these are things that you should be discussing with your advisors. And then finally, the last piece is straight equity. You can offer 20% of the company for $1 million. Okay, which means your valuation is going to be pre-money $5 million. And that's the simplest way that you can have a term sheet of straight equity. So if there are any questions on this, I can take them now, or we wait to the end. But this is a whole conversation in of itself. And when you look at the term sheets that you're considering, you have to have the same mindset as the investor, because this is something that you negotiate. You may have one idea, the investor may have another, and typically what happens is, you come to a meeting of the minds, and then you get to the term sheet that you're both agreeable to. It's a win-win for everybody, and then you move forward. So key component in this is the term sheet, and spend a lot of time thinking about that, because it'll be the basis for your relationship.
Hey, Jack.
Yes.
I'm not sure, Yolanda, is that a question that you're asking in the chat?
Yeah, I was just trying to clarify, when Jack Cohen said debt, you're referring to startups don't qualify for a bank. Is that what you're saying?
No.
You say debt. What do you mean with debt?
Okay, so what happens is in the capital markets,
Right.
You can go to a bank and you can get a loan. Okay?
Right.
The probability of getting a loan for a startup is less than 1% of the folks that go to a bank for a startup will get money from a bank, because you have no way of, unless you have some collateral,
Right.
unless you have some other form of income, a bank will not finance a startup. Typically, that's typical. Yeah, I don't know of any bank that will give a loan without collateral of some sort, or someone that can service the debt. And I mean, I've not seen it. Doesn't mean that it doesn't exist. As I said, these.
Yeah, Jack, I have to add, in almost, over 13 years of teaching entrepreneurship and being a founder, I've never seen a bank give a loan on just a startup idea. It just doesn't exist. It's a myth.
It's hard. Now I will tell you that there are exceptions, and I'll give you an example of an exception.
Jack, I'm just going to say this. I'll say this, Jack. Sorry for interrupting you, but
okay.
It depends on the business, and it depends on the bank. So traditionally, for most businesses, no, but it depends upon the type of business, and it depends upon the bank. So
Absolutely.
I'll leave it at
Absolutely.
that. So if the bank has a
absolutely.
history, if the bank has the
there's always going to
history,
be exceptions. There's always going to be exceptions.
right? If the bank has a history of financing your business, then they will finance it. So my business is private adult residential facilities. I have 5 banks. 85% of their business is in private adult residential facilities. So they will finance a startup if your business plan and your executive management team supports your business.
Can I ask you a question?
Yes.
Does your business receive any outside funding from the government or any government agencies?
No.
No? Okay. Well,
No.
Okay.
But I can give you 4 banks. It just depends. If you, like a fintech, if you find a fintech bank that is accustomed, if your business model of your corporation is similar to that financial technology bank, and if they feel comfortable with it, they will. So
yeah, there's always going to be exceptions.
Yeah,
There's always gonna be
right.
exceptions.
I
It is
can't
worth
disagree
it.
with you.
Anyways.
yeah, and I can give you the names of those banks.
Yeah, we can,
So-
and we can do one-on-ones afterwards. And
Yeah,
talk a little
yeah.
bit more
We'll
about
talk
that.
about it, because I do
Okay.
want to just, so I wanted to,
And yes,
I had a question about that debt capital for startup. It just depends.
That's okay. I said at the outset, a lot of this is basically road cones and guidelines, and you're going to find that there are exceptions to everything, and there are different interpretations from various kinds of entities out there, and that's okay. This is just guidelines. That's all. There's no absolutes. Okay. And if you know of a bank and you can share that information with people who are looking for money, do that, because you're doing people a favor then. And it just helps them helps them get the money that they need. And startups generally don't care where the money comes from. You shouldn't care where the money comes from. What you should care about is the terms. That's the more important thing. And also, if it's an investor, you need to care about the personalities involved. And I'm going to talk about that. That's the flip side of this whole conversation, is the investor side, and vetting the investor. So the last piece is an exit strategy. Investors like to see an exit strategy. It's not an absolute. It's perfectly okay to say, I'm not really sure. I think I may want to spend some time in this business and grow it and then see where it goes. And maybe 5 years, maybe I'll think about an acquisition or a merger or an IPO. But a lot of startups, a lot of people who are entrepreneurs go into a business with the idea of getting that business up and running, building up the valuation, and then capitalizing on the valuation growth and exiting the company. And so if that's your plan, be able to articulate what you think your most likely path is going to be. It can change, okay? It can, and it often does. But an investor likes to think that you have a better handle on what you're doing when you put into your business plan and your executive summary an exit strategy. So please keep that in mind. So the idea of all of this is that when an investor is available to listen to your opportunity, they want to know why you're investable, and they want to know why they should write you a big check. You should be able to articulate that in 20 words or less. That's your elevator speech. And if you can get it down to 10 words or less, even better. Because investors want to net it out real quick, okay? So this is something that you should work on and spend some time on, in being able to identify why someone should write you a big check. And that is the last question that I ask every single entrepreneur that comes to us looking to help raise money, is why should an investor spend money with your project? And to Yolanda's point before, 2 Novembers ago, we had a guy come to us who owned a couple of shipping barges, and you've seen those things offshore in the news, with thousands of containers, right? Well, those things hold thousands of containers. This guy had 3 barges full of containers, and his idea was to fill those containers with soil, hydroponic soil, and grow food in the containers using a drip system, equipping the barges with a water purification system from seawater, grow grain at sea, and then ship the barges to a customer when it was time to harvest. Well, we all thought he was crazy, but we found one investor that was interested in renewable food sources, because it doesn't require a lot of water to grow food in a hydroponic environment. He raised $11 million. And to Yolanda's point, $5 million of that was in equity, and $6 million of that was in banknotes, in bank debt. So yes, you can raise startup money, debt capital through a bank. You can do it. So to your point, Yolanda, yes, you can do that. So I just want to acknowledge that. All right.
Thank you. But you do have to know the bank. You have to know. You got to know the bank. You got to know the bank officer.
Yeah.
You have to know what do they lend in and what do they make money in.
You got to know your partners, exactly.
Yeah, you got to know that bank. You have to. So, okay, I just wanted to say that, because the bank is a paper, and it's cheaper paper as well.
And I appreciate it is, by the way, bank debt is way cheaper than private equity debt markets. You'll pay a premium, and the reason why people will pay a premium is because they don't want to deal with the time involved in going through a bank. And often you can get private debt capital in as little as 7 days. Substantial debt capital, but requires a certain profile of client to be able to do that. All right, so now it's your turn, right? So in raising money and looking at investors, you got to think about some of these concepts. How much capital am I raising? How much money do you need? What does my ideal investor look like? Because when I partner with an investor who's going to lend me money, I want to make sure there's some compatibility there. You want someone that's going to be additive, whether if it's straight financial additive, whether it's expertise, whether it's management expertise, whether it's hands-on expertise, you want to make sure that you understand the profile of the investor that you want to work with. It's key. You don't want an albatross of an investor around your neck. And the last thing you want is an investor that really doesn't understand your business. It doesn't happen too often that an investor doesn't know a lot about the businesses they invest in, but every now and then you find an investor that does that. Make sure you weed those folks out, because they can be detrimental to your business plan. And the third thing is, how much involvement do you want from investors? Do you want them hands-on? Do you want them at a distance? Do you want just their money? These are things that you have to ask, so that when you do arrive at a term sheet, the people that you're working with, or the person that you're working with, is going to be a compatible partner for you. It ruins many companies when that happens. The other thing to think about is what round you're in. I think I showed this before, and again, these are just gates. They're not with movable cones. Okay, there's no absolutes here. Figure out where you are. If you're a pre-seed company, where your proof of concept is in development, you're just maybe hiring some people. Typically the investors are going to invest anywhere from $10,000 to $1 million. As your business progresses in both size, complexity, and revenue growth, and expanding markets and so on, the amount of money that you raise goes up. When you get to Series A, after your business is up and running, you're talking millions of dollars. Some investors will consider 5 million Series A. Some will consider 3 million Series A. Typically, from what we see on an average basis, it's generally north of $10 million in terms of Series A money. When your company gets to a point where it wants to expand in terms of new markets, new hiring, new products, and so on, you go to Series B. That's in your $15 to $25 million range. And then when you get to capital expansion or international growth or acquisition of other companies or IPOs, you're generally talking anywhere from 25 to 30 million and above. And so just understand where you are, understand how much runway you need in the funding, how many months at the burn rate that you anticipate is that money going to last. And that's why I talked about burn rate earlier. If you're going to borrow $1 million and you're spending $100,000 a month, you're going to last 10 months, obviously. Okay. So, think about all of these various things as you go out and put together a proposal, an executive summary, or a business plan in terms of, how much money you're going to raise, how much money you're going to be spending every month, and how long that money is intended to last, and what you're going to do with it. And then a key consideration, a very important consideration, is what is the minimum check size that you want? Now, I got to tell you, I was in sales for many, many years. And from a salesperson's point of view, our attitude was no commission check was too small. And there are some entrepreneurs that believe no investment check is too small. And that can be a critical mistake. And it can be a critical mistake because check sizes generally are associated with the type of investor. And the type of investor is something that you need to consider when you're raising money. And so, there's a whole process to this about figuring out what investors are going to write what kind of checks. All right. So if you look at, the profile of investors, and again, these are just generalizations. All right. You're going to find exceptions to everything here. There's no absolutes here. OK, I want to make that pretty clear. All right. So an angel investor generally invest in early startup stages. They generally invest anywhere from $1,000 to $25,000. You'll find angels that write six-figure checks. Often, as a matter of fact, but typically this is the profile. Then you have high net worth individuals. These are people that have built up a cache of money. Someone, let's say, like Conrad Previs. Okay, Conrad Previs was a local real estate magnate here in San Diego and built a multi-billion-dollar empire. His name is all over buildings all over San Diego. You know, not only is he a high net worth individual, he's a venture fund and a very large family office. So, you know, he falls across many different categories here as an example. And so, you know, the high net worth individuals, doctors, lawyers, attorneys, business people that accumulate large amounts of money and invest, you know, are investors, and they typically write checks from 25K to 2 million in a lot of cases. So, you know, identifying these people is important. Then there's family offices. Now, I'll give you an example of a family office. Qualcomm, for example, the Jacobs family, you know, built a multi-billion-dollar business. There's a part of their family that has an investment practice. It's run by a family member, and you know that group invests, you know, family wealth into projects that the family wants to invest in, and they will write checks. You know, family offices like that will write checks anywhere from $100,000 to $5 million, in some cases more. You know, when you talk about the Prebys family office, for example, you know, they write 20, 50, $100 million checks and sponsor really big projects. Okay. So
Jack,
you know,
I was gonna, I see that we do have one more question, a hand up, but we're very close out of time, and we do have people who are going to be going to other classes
Okay.
afterwards. So we're a little close on time, but
I'm almost done, actually.
yeah,
Go ahead.
you
You
wanna
have a
finish up and
question?
then so we'll finish up and then we'll take questions. Yeah, go ahead and finish up then. Yeah.
Yeah, I'm almost done. Okay.
Of course.
So you know, these are the various kinds of investors out there, and you should be looking at family offices, high net worth individuals, and angels in your startup stage primarily, just as a target for yourself. Okay. The next point is that, you know, when you look at investors, how many investors do you want? That'll determine the size of the checks you want and how involved do you want them to be in your business. You don't want too many cooks in the kitchen, especially if they're, you know, if they're going to put too much salt in the soup, you know, you got to keep them out of the kitchen. So keep in mind that you want to control the number of investors into your business so that you can manage investor relations pretty carefully. It's a key portion of vetting investors. And then this is the summary. This is what investors want to know. They want to know why and what you're all about, and you know, the things I talked about: the business plan, the stage, how much you've raised, and so on. So, you know, this is just kind of a review screen of all the things we talked about today. You know, you have as much of interest in vetting investors as they have in vetting you. So keep that in mind. It's a two-way street. And with that, I know we're out of time. I know this ran a little longer than I thought, but I can take on whatever questions the time allows.
Yeah, the hour goes by so fast. So thank you
I
so much.
really,
Yeah.
I was trying to go slow a little bit
Yeah,
too,
right.
but
Right. So wonderful.
Right.
So I do see a hand up. So Wensit, did you have a question?
Yes, I do have a question. I am the CEO of an innovative and decentralized ag and decarbonization company, and we have a proven proprietary IP as well. And how can I contact you?
Yeah, what's the best way for people to reach you, Jack? Yeah.
Oh, okay. All right. So if I'll put it in the chat box, okay?
Sounds good.
Okay.
Perfect.
And also, we seek to raise 500K for marketing, pilot projects, and executive compensation as well.
You're looking to raise 500K?
Yeah.
Okay. All right. So I'll put my phone number in here in the chat box along with my email address. All right.
Okay. Thank you so much.
Oh, you're welcome. And feel free to email me or call me.
Awesome. Wonderful.
Okay. Any other questions?
Any other questions from the audience? All right, so we have, thank you for sharing that, Jack, and thank you. We do have a lot of thanks from the audience. And just a reminder to everybody, you can also follow the rec on our social media. Come back, we have lots of amazing webinars like this. We have lots of opportunities for you to meet with advisors and mentors such as Jack, and we're here to help you to succeed. So
yeah, by the way, last point is that I put my phone number and email in there. If anybody has any questions, they just to bounce ideas off of, I'm more than happy. This is not a commercial enterprise here. This is an advisement and consulting kind of opportunity. I don't commercialize this when we do this. This is strictly to assist people who are starting out in life and trying to get a leg up on what they're doing. So
And
I'm happy to answer any questions that you have.
And that's why we appreciate you
Yeah.
coming so much. It's just amazing.
And
So-
if there's feedback, I'd like to get feedback on how effective this was.
So
okay?
I want to encourage all of you to please do complete the feedback form.
Yeah.
Crystal put the link in the chat for our feedback. Please let us know what you thought. We'll send it right on to Jack. He can see exactly, what you said. Yeah, and we'll send that over to you in the next couple of days, John. So
And thank you, Londa. I really appreciate her input. It's, never stop questioning the status quo, please.
there you go.
That's what makes you an entrepreneur. Never accept, accept conventional wisdom.
Right. Awesome. Well, thank you, Jack. Thank you, everyone. And have a wonderful day, everybody. We'll see you at the next workshop. And again, at the Rec Innovation Lab. Thanks, everyone. Take care.
Take
Bye.
care. Bye-bye now. Thanks so much. Appreciate
Thanks.
it.
Yes, absolutely.
Bye-bye.